Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Prosperity is the best protector of principle. Man is the only animal that blushes or needs to. One gets such wholesale returns of conjecture out of such a trifling investment of fact. Few things are harder to put up with than the annoyance of a good example. Those that respect the law and love sausage should watch neither being made.
Here's the US debt story in two pictures. On the left, total debt piles up like an all-you-can-eat buffet. On the right, you can see who's been doing the eating. Mostly the government. Public debt shoots up, while households and financial firms have been on a strict diet since 2008. So when people say falling yields in 2025 are because the private sector suddenly deleveraged, nope. That trend has been around longer than the iPhone. Markets priced this in ages ago. Something else is pulling yields down lower this year, but it's definitely not households discovering minimalism. As Will Rogers put it, the budget is a mythical beanbag. Congress votes beanbags, the president keeps beanbags, and the taxpayers gets the beans. Here's the 2025 profitability leaderboard, and surprise, surprise, it looks like a tech reunion party. Alphabet, Apple, Microsoft and Nvidia practically own the top row, while Saudi Aramco shows up like that one non-tech guest who still brings unbelievable profits to the buffet. Banks cluster in the middle, grinding out earnings the old-fashioned way, and Visa is over there flexing a profit margin so high it should come with a warning label. The big picture, profits in 2025 are more concentrated than ever. If earnings were gravity, big tech would be a black hole. Everything gets pulled towards them. India's inflation story is basically a grocery bill with a GDP complex. Food makes up a massive 48% of the CPI basket, nearly double that of China, Japan or Brazil. Meanwhile, richer economies obsess over housing. The US gives 44% weightage to shelter, meaning that inflation rises when mortgage rates merely think about moving. And transport, India is just 8.6% because when a nation of two-wheelers and jugaad doesn't exactly move the global oil needle. In short, India fights inflation in the kitchen, the West fights it in the living room. Different rooms, same headache. Here's a reminder that while we are comparing SIP returns, someone paid $450 million for a guy painted by Da Vinci staring into the middle distance. Art auctions are basically the Olympics of I have too much money, let's compete. Picasso appears so many times on this list, he may as well get frequent flyer miles. Klimt, Modigliani, Monet, all turning canvas into blue chip assets. And yes, even Warhol's Marilyn is now worth more than many unicorn startups, which is quite honestly fair. Marilyn had better fundamentals. The real punchline? Most of these artists lived broke. Today their work sells for GDP numbers. Here's a global defense scoreboard, or as economists call it, the world's most expensive trust issues. The US leads with a jaw-dropping $997 billion, spending more on defense than some countries produce in a year. China follows at $314 billion, quietly building hardware like it's a weekend hobby. Russia and Saudi Arabia, they are the true shockers, both spending over 7% of GDP, basically running a national security subscription service. Then there's Ukraine, dropping 34% of its GDP on survival, the economic equivalent of all in or all gone. India, the UK, France, Japan, all sitting in the steady 1.1 to 3% zone, balancing defense with, actually running the country. India's steel story has been running hot all year, but the last few months look like the industry finally paused for a sip of water. Crude steel growth cooled to 6% year on year in October, its weakest in 5 months, and finished steel slowed down to 8%, the softest in 4 months. Still positive, still healthy, just not bench pressing the economy the way it did earlier. The real drama, pig iron, down 15% year on year, its sharpest fall since March 2023. That's basically the steel ecosystem saying, let's not get ahead of ourselves. Big picture, growth is intact, but momentum is definitely catching its breath. Here's a chart that quietly says, the Capex party is back. Gross fixed capital formation, basically the economy's long-term investment backbone, has climbed back to nearly 34% of GDP, levels that we last saw a decade ago. After sliding to around 31% in the mid 2010s, GFCF spent years stuck in low gear. But from FY22 onwards, it's been inching up steadily. Thanks to government infra push, healthier corporate balance sheets, and banks that finally remembered how to lend again. A rising investment ratio means more factories, more roads, more jobs. It's a start, but quite a distance to go. Here's the state of the AI traffic battle, or as Silicon Valley calls it, the game of clones. ChatGPT is still the undisputed heavyweight, but its share has slipped from 87% to 71% over the past year. Still dominant, just no longer the entire internet. The real climber is Gemini, now at 15%, after the Gemini 3 push. Basically, Google saying we are not late, we are fashionably on time. Grok keeps inching up after its 4.1 release because apparently sarcasm does sell. Meanwhile, DeepSeek drops to 4%, proving that speed alone doesn't win the race, consistency does. Perplexity, Claude, and Copilot are small but steady, the quiet kids in the class who might top the exam someday.